The market feels like it's on edge, almost waiting for something to break. And knowing the concept of balance usually leading to excess, the significant daily balance that we've been building over the past couple of weeks should, in theory, lead to significant daily excess. But the key question always remains, in which direction? That's the key question we'll look to answer in today's episode of the Weekly Watchlist. Note that in 2022, we saw balance usually leading to excess in the downward direction throughout multiple instances. But something has already changed in 2023 where we saw balance then lead to excess in the upward direction. Will this time be the same? Once again, that's what we'll look to answer in today's episode of the Weekly Watchlist. Of course, anything we're associated with is linked down below in the description. And a quick thumbs up on the video before we get started is always appreciated. Let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, once again, we have another bearish inverted hammer. The large upper wick, of course, represents a failure from the buyers to hold prices at the top of the range, and instead we get a reversal back down to the opening print and through the opening print because of the red-bodied bar for some range expansion in the downward direction. We've got a fairly weak close once again at the lower third of the week's range, almost identical to last week's bar as well, so structure here definitely goes to the bears once again. If we think about location, it's just like last week as well, technically a little bit more nuanced with a bar-to-bar lower high and a bar-to-bar lower low, but you could make the argument that we have a double inside bar still being contained within the original green bar's range. If you want to analyze this little bit of price action here underneath a microscope, I would also say because technically we broke an inside bar's low and there was no follow through to the downside in the past week's worth of trade, it's really indicative of balance and a market that's hanging in limbo waiting for more information. So location continues to not be so clear, but overall structure is becoming slightly more bearish. If we take a more nuanced approach and start to think about some of the other things on the weekly time frame chart, we've closed once again above a 50 SMA. We've closed on the bullish side of the resistance trend line. But from a bearish perspective, we have also closed back down underneath the November pivot high. So not so clear from a location perspective on the trend count. We have lows, higher lows, and we still have highs and higher highs. So it's still reasonable that the weekly time frame chart is searching for a higher low. And as we've pointed out in the past, the 390 zone right around here is the ideal place for that higher low to form. We know that because if we take a look at the volume profile chart, it continues to be reflected as a high volume node, and we are pulling back off of our overhead high volume node closer to 420. If we get the rotation here, it's an equal high. If we rotate to 390 and bounce off of it, there's your opportunity for the higher low on the weekly time frame. Taking out the Fibonacci's, I would continue to reinforce the idea that coming in from the low up to the high, your 38.2 ideal bull flag consolidation is 391.28. Moving down to the daily time frame chart, we can see that the weekly expected move here is bearish. And if you don't know how to calculate these numbers, here's a tutorial in the top right-hand corner. The upper edge of the weekly expected move is 414.63, a clear lower high underneath the equal high at 416.75. The lower edge of the weekly expected move is at 399.90, a clear lower low underneath 403.75, where we turned and pivoted from on the Friday afternoon session. Overall, from a trending perspective, the nuanced trend of this box right here is very neutral, with consecutive lower-ish highs and also lower-ish lows, higher lows, lower low here. Definitely neutral and balanced in this box, but let's not forget about the overall daily uptrend with lows, higher lows, and certainly right at the line in the sand, 403.75 as our higher low on the daily chart currently. The reason that we can stay bullish on this trend is because we have a hammer candle here. Let's talk about the nuance of that hammer candle. So technically it closed above the prior pivot low here at 405.75 from the liquidation break 2 weeks ago. And we've also respected 403.75, the place where the FOMC rally began from, and the higher low structure that was above the $400.75 mark breakout zone, which was already confirmed as a higher low right here. So if the market is going to remain in an ideal uptrend going forward, we can't really afford to get down underneath 403.75. Let's talk about some of the psychology. On Friday, we technically have a gap down. There is a thrust in the downward direction, even price action intraday holding underneath, but once again, we close above 405.75. Doesn't seem to me that sellers are making any significant progress on momentum in the downward direction. Don't get me wrong, from a nuanced perspective in this overall box, I would certainly concede that these lower highs are meaningful progress in the downward direction, but from a daily trend perspective, from lows up to highs, not all that much damage has been done. So 403.75 must continue to hold if we take out the Fibonacci's from the low. Up to the high, we'll remember and reinforce the idea that 38.2 bull flag consolidation sits right at that level, 403.75. And if we take out our anchored VWAPs from the 2022 dips and the all-time highs, even anchored to the start of the breakout bar back here, you're getting confluence of support around this general area. Remember that over time they will slowly start to creep up and provide confluence literally at 403.75. So the fact that we remain above the anchored VWAPs, the fact that we remain above the Fibonacci's, and we are holding on for a daily higher low has to strike me from a technical perspective, of course, as being more bullish than bearish. We've got a daily hammer candle. We're watching for a break over the hammer high to get above 410 with a higher low and then reattempt the equal high up around 416.75. That to me would make the most sense if you are a market bull looking for this trend to continue in the upward direction. If you're a market bear and you want to see the market fall apart here, what you of course want to see is a lower high underneath 410 and a violation here at 403.75. When and if that happens, the daily trend immediately flips to being neutral, and of course, the more lower highs we continue to get underneath 410, the more breakdown and time spent underneath 403.75, the more likely it is that we will flip into a daily downtrend, and from there, we can start to have some bearish expectations of this market. A big breakdown level, of course, would be this $400.75 mark to get you back to your prior lows and the weekly higher low zone. Really, you've got daily structure at 393.50, and then, of course, 390, the weekly level that we were just discussing. Let's have a look at our market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. What I want to point out from a volume perspective is that, yes, the outflows were significant on Thursday when the breakdown really happened, and we did hit that negative 300 million mark, but notice cumulatively on the week, we are still positive. We had inflows to the tune of roughly 200 million, so certainly not significant, up around 1 billion positive, but it was still net inflows. If we look at the advanced decliners, notice that most of the week was spent underneath the zero line, but in almost all instances, some attempt at a trend higher was produced. If we look at the ticks, you'll notice it's pretty barcoded here, but overall the cumulative build would certainly not suggest any serious sell-side momentum. It's actually quite convenient that Monday was a significant buy-side day. You'll notice that you want to see a read in the cumulative up and over positive 4,000 for bullish nature or down and underneath negative 4,000 for bearish nature. It simply didn't happen. So although we are acknowledging some change in tone in this market in the downward direction, the momentum is simply not there in the underpinnings of the market for follow-through at this point in time. That could change, but as of right now, we're not seeing significant sell pressure in the past week's worth of trade. What I really think is taking place here is that you had buyers really tired from the Tuesday, Wednesday, Thursday sessions who broke down into the afternoon there when the sort of Fed talk came out. It's really indicative of liquidation break, not so much serious sell-side pressure. Notice even on the Friday session, as we're accepting underneath the 3-day balance, there's no aggression from the sellers. Nothing significant is happening at these lows, and we rally into the close. So I think you really had a case of tired buyers up here. That's evident in really the flows on Tuesday, Wednesday, and early Thursday. And then, of course, Friday, a little bit of price acceptance lower, but sellers not stepping on the gas from a momentum perspective in the downward direction. Let's take a look at the market profile. Quick tutorial in the top right-hand corner if you don't know what this one is. The main takeaway from this screen is really what happened over the 3-day balance we were just looking at on the internal screen. Notice that value area is lower in the session here. Value area is lower here, and value area is lower here. Of course, point of control, also lower in the session, lower in the session, lower in the session. So there's definitely a change in tone. Once again, buyers are getting tired, it appears, up here towards these highs, and the poor high from Thursday really leads to that breakdown into the afternoon session and some slight follow-through on the Friday morning session. Friday session is extremely important to read into because although we did close at the highs for a daily hammer candle, notice that value was still technically lower in the session and the point of control also lower in the session. As we pointed out on the SPY daily time frame chart, we will learn something if we get a break and higher low above the 410 area, which is roughly equivalent to to 4,100 in your ES futures. With the poor high from Friday, that area could use repair. If we break and rally once again, getting above 4,100 for a higher low would be meaningful for the bulls. A lower high underneath, oops, if we clear that up, try one more time, repairing that level, so a break of Friday's high, stuffing for a lower high underneath 4,100, expect bearish outcomes as we move forward. Back on Thinkorswim, we can evaluate the weekly performance of our sectors. Notice that the XLY consumer discretionary led the pack up 1.64%. Does strike me as more bullish than bearish, noting it's a heavier weight risk-on sector. Slight cause for concern is that it was followed by utilities up 1.09% and staples up 0.67%. Both of those sectors are much more defensive and risk off from a posturing perspective. At the bottom of the barrel, we see the energy sector down a whopping 5.86%. A lot of damage done on the Friday gap and go session, but it does remain technically in a daily balance area. We'll have a look in just a moment. It was followed by real estate and materials, both really lightweight sectors, not worth reading into from a leadership perspective. The heavier weight sectors were technically red on the week: tech, healthcare, and financials, all coming in the red zone. Having a look at the structure from the XLY, notice that we continue to get balance above the prior balance in this area. We want to see holds of 148 and follow through over Friday's high to get the equal high back up at the top of balance, 154.50. Subsequent breaks above that would of course be bullish pressure for your S&P 500. If you're a market bear, you want to see a lower high underneath 148 to target this gap close underneath us at 141.75. Continuing along to XLU for utilities, notice that we're getting balance down here at the lows. Speaking from a leadership perspective, as long as it's not breaking out and leading rallies higher over 72, not really a cause for concern. We also don't want it falling off of a cliff, so the fact that it's holding this area after a fake break around 67 does strike me as positive for your S&P. Similar things can be said about the staples sector, continuing to go sideways in this overall balance range. No leadership over 77.35 and also not threatening the breakdown underneath 72 with the big bullish bar from Friday's session. XLI for industrials continue to build out this very nice looking ascending triangle. You could call it a weekly or monthly bull flag. Watching for bullish outcomes over 103. It doesn't appear to be a threat in the downward direction until we start getting price acceptance with lower highs underneath $100.50. Next up is the communication sector. This is something to keep an eye on for intra-week bearish pressure in your S&P. Notice that we're already starting to build out a little bit of a node here for a lower high. The reason I would call that meaningful is because we technically break two equal highs, solid close on Wednesday, and then just absolutely no follow through back in the upward direction. So intra-week breaking down underneath 54.30, you could look to retarget the top of this prior balance at 52.17. From a weekly perspective, we could certainly offer up lows and higher lows, but once again, intra-week, it is bearish for your S&P 500. Next up is that energy sector falling off of a cliff from Friday's session, but still in this daily balance area. As we talked about with utilities and staples, we want to see them going sideways, not threatening big breakdowns, as long as it remains above 82.67 and its daily 200 SMA. Not really concerned yet inside of energy, but certainly keeping an eye on this one, considering the momentum from Friday's session. Next up is the real estate sector, much lighter weight and also has much more to do with the wealth effects, technically giving up key support on the Friday session with acceptance underneath 39.85. In this area, it strikes me as much more neutral. Positive outcomes over 41.35, bearish outcomes underneath 37.25. Not really a concern right now for markets. Similar things can be said about the XLB for materials, really lightweight sector. Bears, of course, want to look at this as a head and shoulders, breakdowns underneath 80.75. Bulls want to look at this as a cup and handle and watch for positive outcomes over 84.25. Anything in between these two zones, not too meaningful for your S&P. Next up is the tech sector, heaviest weighted sector of them all, certainly meaningful for your S&P. Finding a hammer candle at the lows of balance here on Friday's session, supporting off of this prior area of resistance, prior area of resistance, prior area of resistance. Bulls want to see a recapture of Friday's high to get back to the top of balance at 144, then a break to close the gap overhead from 146 to 147.85. Bears, just like in the XLY, want to see a breakdown and lowered high underneath 139.25 for intra-week bearish pressure, but still a weekly opportunity for a higher low off the prior top of balance here at 135. We'll kiss this one goodbye when and if we find a lower high underneath and we start getting more acceptance in this prior balance area. Next up is the XLV, really impressive move from the Friday session. especially noting that we had a prior inverted hammer gapped underneath the key support, underneath the daily 200 SMA, and there was no follow through from the sellers in the downward direction. The fact that this has been on such a sideways malaise in the downward direction is kind of keeping markets from falling apart. If this were aggressively breaking down, violating this support here at the 130.50 mark, filling this thin structure off to the left, that would be a big concern for markets. The fact that it rebounded so solidly on Friday's session does strike me as a positive force for neutrality in our S&P 500. Bullish outcomes over 133.50, looking for that reattempt to this prior structure at 137. And of course, if it does end up flushing 130.50, look out below in the S&P. Next up is the XLF continuing to go sideways above prior key resistance, resistance, now turning into support. The more time we spend above 36, once again, the more we are looking for positive outcomes over 37. Your next breakout point is 38.15. That would be bullish pressure for your S&P 500. Here's our sector ratio grid. If you want to learn how to set it up, there's a tutorial in the top right-hand corner. The top four are our risk-on sectors. Notice that things are looking fairly decent. The XLK is coming in for a higher low pullback, hopefully anywhere above this prior area of resistance. The XLV is finding now a triple bottom off of these lows and threatening a break over that neckline. You could think of it as a weekly double bottom. This, of course, is bullish for a reversal and speaking to risk on in the second heaviest weighted sector of our market. XLF wants to find that breakout over the 36 zone that we were just discussing, or was it 37? Definitely 37. And that, of course, should perk up the ratio here, speaking to more of a risk on posture in our market. And the XLY saw a very shallow pullback and once again is starting to break the bull flag consolidation. This does seem to me to be more of a risk on posture than risk off. If we look at the bottom four risk off sectors, things are starting to curl slightly higher here, but we're still underneath a descending 50 SMA, curling slightly higher here, still underneath a descending 50 SMA. Energy falling off of a cliff, obviously, and real estate really much more sideways than anything else. This will become meaningful for risk-off posture if we start poking above. If we start poking above these 50 SMAs, not the case as of right now. Looks more risk-on than risk-off. Our growth versus value ratio could start to become a threat on a breakdown of this low here. Of course, the main zone that it needs to hold is this area at 1.88 for a weekly higher low, something that would look like this. This, of course, represents prior support, a little bit of confused support, but of course a lower high underneath as the nail in the coffin for this move lower here. A higher low above that zone would strike me as positive and constructive for bullish outcomes moving forward. Having a look at the dollar, although it did break out of the daily bull flag, I would note that there's a strong opportunity still for a daily lower high underneath 105. If we zoom in on this, we did technically close above the top of the flag, so it doesn't guarantee we have to see upside outcomes, which of course would be bearish for equities, but I would keep an open mind to the dollar having a really deciding week in the coming 4 days worth of trade. If we get back down underneath the low end of this flag here, which just to give you a number is underneath 102.60 roughly, that would strike me as starting to become the confirmation that from here to here, we've got ourselves a daily lower high and the downtrend remains intact. The confirming piece of evidence for this would be if we have a look at the GC gold contract. Remember that we were talking about the discrepancy between the bear flag happening here and the bull flag in the dollar, which was already around this key prior consolidation zone. Well, the gold contract has already found a daily hammer well above the prior top of the balance, and it could offer up a weekly higher low above 1820. Breaking Friday's high with follow through back to the top of the flag consolidation at 1900 would have me feeling much more positive about bullish outcomes in equities and of course downside bearish outcomes in the dollar. Having a look at the TNX 10-year yield, certainly a noteworthy chart for the upcoming week's worth of trade. We are sitting right at key weekly resistance 38.8 or 3.88 in the 10-year. If this turns into a weekly double bottom and we see a breakout with follow through over that level, it of course should in theory put some downward pressure on equities, primarily the impact it would have on the tech sector. So watching this one like a hawk into the coming week's worth of trade, it needs to find sideways acceptance here if the market's going to be more comfortable about bullish outcomes as we move forward. Having a look at the Fed Watch tool, we'll continue to note that markets are fairly concerned about a rebound in inflation in early 2023. This is primarily interpreted through the increased odds of a 50 basis point rate hike for the month of March. This is also coming on the heels of a fairly lackluster CPI report, blazing hot retail sales, and a big miss on the PPI number. Fed Chair Mester also came out on Thursday reiterating her desire for a 50 basis point rate hike as we move forward. Now, I think it's fairly unlikely Jerome Powell U-turns and gives us a 50 basis point rate hike. You can currently see an 80% probability of 25 basis points. However, going forward, he can hold rates higher and for longer. Looking at the anticipated terminal rate, you can see that we are finally pricing in 525 to 550 and holding it there for quite some time. If you recall, in the past, we had 2 rate cuts towards the end of 2023. Now we're only getting 1. This speaks to a very difficult environment for tech to outperform in, which we know is the heaviest weight risk-on sector, could from a fundamental perspective spell more pain for markets to come. Now let's think about earnings. It's been no surprise, and we've covered it with the data from FactSet, that we are massively underperforming the 5-year and 10-year averages from a beat perspective and revenue perspective. But let's take it one step further and put some numbers on the paper. If we take a look at the S&P 500 earnings and estimate report from spglobal.com, you can go and download this data set on your own. If we take a look at the as reported earnings per share, we're currently looking at for Q4 of 2022 about 38.38, and only 84% of companies have completed their reportings as of right now, so this number is subject to change. But let's do some very quick back of the napkin type math. This is not meant to be a perfect financial model, but you get the gist. If for Q4 of 2022 we're getting 38.88, we annualize that 4 quarters in a year, we're getting $153.52 per share in the S&P 500. Now, historically, a 17 PE ratio has been very average. If we do that math, we're left with an S&P that's technically worth, from a fundamental perspective, 2,600. We're obviously trading much higher than that at this point in time, so markets are pricing in some sort of recovery, but it speaks to the valuation of the market probably being higher at this point in time than what it technically should be. And if we layer that on top of the fundamental narrative that Jerome Powell will raise rates higher for longer, you can imagine that this number has some room to fall in the downward direction. Doesn't speak to what we should do tomorrow when the market opens. As a day trader, we have to follow the trends, but from a macro narrative perspective, this is worth keeping in mind. Let's get back to the technicals and look at the risk appetite for our market. Overall, there's no outperformance in the TLT. It's actually underperforming the S&P equities right now, so there's no flight to safety type trade. It would speak to comfortable amounts of risk taking in the equities market. Having a look at the HYG smart money versus dumb money, so to speak, this did show us a divergence here versus sideways up here in equities, and that did play out. We started to go sideways and break down on the Thursday session in the S&Ps. It would speak to risk appetite staying slightly elevated. It's certainly not evaporating, getting down underneath this prior pivot low, but it would speak to some skepticism out there in the market, which is completely fine considering the daily balance in your S&P 500. Something that I do find interesting is that if we take a look at the Bitcoin daily chart, or weekly chart rather, we are finding a beautiful higher low above the prior breakdown candle high, which should spell improved bullish odds for our equities markets. Not a one-to-one, but overall risk appetite does remain intact for the market. Having a look at market breadth, new highs versus lows, looks okay, staying above the zero line, turning for a little bit of a bounce there. Remember that we want to avoid a look like this, avoid a look like this, and morph into something like we saw in 2021, something like what we saw in 2021. That's if you're a bull. If you're a bear, of course, you're welcoming a breakdown of the zero line. Currently don't have that in new highs versus lows. If we take a look at the S&P companies above their 200 SMA, beautiful opportunity for a higher low pullback above this prior breakout point. Of course, this is not a technical chart, but it would speak to more companies getting above and staying above their 200 SMA. If we have a look at the same thing except for the 50 simple moving average, you'll notice that it's starting to trend slightly towards the bottom of this balance range here. As long as it stays above the 50% mark, that is overall bullish for markets. We don't really want to see it up around 0.9 or higher. That's the contrarian zone. So this does strike me as comfortable for the S&P 500. What about the equal weight RSP versus the weighted S&P 500? I would just point out, if we zoom in on this, the beautiful break and retest, yet again, another hammer candle off the retest of prior resistance, turning into support, with the hammer candle from Friday, turning into support. Bullish outcomes, if we hold that level, speaks to the improved bullish nature of the underpinnings of the market, not so much focused on a few bad apples, so to speak. Revisiting the Dow Transports divergence, we'll notice that we found a nice higher low in the transports, but but we're still not getting any confirmation over this breakout point in industrials. If this does happen to break, it would certainly be a great confirmation for bullish outcomes moving forward. If it never breaks, we have to continue to remain skeptical of any further upside rallies until this takes out the top of the range. Finishing off the S&P with some volatility products, notice that the VIX continues to reject prices over 2050. It speaks to bullish outcomes, or at least comfort from the market, so to speak, that, hey, this is a reasonable bottom. This higher low looks great. Keep the risk appetite up and see if prices can continue in the upward direction. Markets are comfortable here instead of on edge about some big breakout or breakdown, which is kind of contrary to the intro we talked about with the daily balance area building. Now, it doesn't mean that volatility can't quickly increase to the upside, and there's been some reasonable things being discussed on social media about this falling wedge potentially resolving in the upward direction. When and if we get price acceptance above 2050, we'll look at that as a reasonable pattern, but if we remain underneath 2050, it speaks to comfort in the market from a volatility perspective. And if we take it one layer further and look at the volatility of the volatility index, the VVIX, we'll just note that we're back down inside of this balance area. Remember that someone made a hedged bet for CPI. We got that big divergence here, but we're right back down in a sort of comfortable spot from a volatility perspective. And taking a look at our volatility futures, we are still in a strong contango happening here, and 9-day versus 30-day VIX is also underneath the zero mark, speaking to present-day risk being less than future, which is of course good for money managers allocating capital in today's present market. And rounding out the broad market with the QQQ, notice that we did not undercut the pivot low from here on the Friday breakdown. We've also closed a dragonfly doji, a bullish hammer, however you want to classify it. Just like in the S&P, we've got ourselves a daily balance forming above key prior structure from here. Does strike me as more bullish than bearish here in the Qs versus the SPY even. I would look for positive outcomes on higher lows or breaks above 302.75 to achieve the top of this balance here. The upper edge of the weekly expected move is at 308.60, and the true high, equal high up here is at 311.75. For bears to really get something going, it's got to be a breakdown and lower high underneath this zone in here, technically underneath 296.50. Having a look at the IWM Russell 2000 and the small caps, we'll see an even more bullish chart with no breakdown into the end of the week, consecutive inside bars happening in here, and still holding on to key prior structure around 188.90, 189. That's the lower edge of the weekly expected move. Because we have these inside bars stacked up, I wouldn't be surprised if a breakdown of these lows violates the expected move low. If that does take place, once again, the lower high underneath, you could certainly start to make the argument for a head and shoulders type pattern like this, and then the bears are off to the race on that lower high underneath 189. Staying above speaks to neutral and really more bullish than bearish risk appetite, noting the overall trend of the weekly time frame chart and even daily time frame chart remains in the upward direction. Bullish outcomes want to break above 196 for the equal high up around 199. And finishing off the broad market with our side-by-side weeklies, it's no surprise that the SPY is underneath the pivot high. We've talked about this on the weekly time frame chart. But notice what's taking place in the QQQ. We're technically getting bull flag consolidation above the double bottom neckline. From a very nuanced perspective, we've also found a weekly higher low on the bar-to-bar count instead of lower low that the S&P saw. If we look at the IWM, we're getting something very similar with bull flag consolidation taking place above the double bottom neckline, and we've got ourselves a green weekly bar. If the QQQ breaks out of this flag, it would be very difficult for the SPY to move south, noting that the heaviest weighted component, the tech component, is seeing bullish structure and respecting the prior pivot high. If the IWM breaks out of its weekly bull flag, it would be very difficult for the SPY to move lower, noting that this is much more representative of risk appetite for our market. Now, if these patterns fail, we will of course reevaluate, but so far so good from a structural perspective. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, we'll dive right into Apple. Notice that we have a daily hammer candle on Friday's session like many other charts we're about to look at, but in this one in particular, because of Thursday's large upper wick, what I want to see here is a higher low intraday above 154 for then a reattempt at the equal highs at 156.50. When and if we get there, watching for bullish breaks in the upward direction, there's quite a bit of room to to run overhead up towards 163.75. For bears to get something going, we need the lower high underneath 151 to start to target this gap close underneath 147.90, fills down at 146.60. Netflix is up next. First of all, note the strong overall daily uptrend here. However, when we zoom in and look at this as a balance area, we've technically closed underneath on Friday's session. So although it is a hammer candle, we've closed underneath 349.65. If we continue to get consolidation underneath that number, watching for a break to come back down and close the gap under 333 to 324.85. When and if that happens, because of the strong daily uptrend that we just saw, I would look for any excuse to buy the pullback here and look for upside outcomes to reattempt really the bottom of the range at 349.65, call it 350 even. If we do poke back up into this range, I would be very cautious and wait for the next confirmation break over 368.50. Next up is Tesla. We talked about the fake break on the Wednesday afternoon video, and it did give us the Thursday fake break here, but it's still remaining above this prior double top from this area right here. That's 197.50. As long as we remain above that level, bull flag consolidation is in play, and we'll watch once again for the reattempt over 213. The target is 227 and then 240.50. That's a bit of a stretch, but if the bull flag breaks, if the market really gets going on a break from balance to excess, maybe it's on the table. Bears, of course, want to see price acceptance underneath 197.50, and then a breakdown of 182.40 really starts to get much nastier. As of right now, with the resilient move from Friday, I would watch for consolidation and a possible upward break. Next up is GOOGL. Really lackluster price action here. Thought we were going to get some more follow through after the Wednesday session, then underneath on Friday, just really sideways. I would start to think of this as an overall bear flag and watch for bearish outcomes underneath 92.75 or possible bullish outcomes, short-lived though, over 97 into 99.50, and then reevaluate for a daily lower high up against that level, starting to eyeball that head and shoulders pattern that would look like this into the future. As a early arbiter of price in the week, 95 can be your zone. If we're above it, I would monitor for bullish outcomes. If we're below it, I would monitor for bearish outcomes here. It's really the midpoint of this flag consolidation range. Next up is Meta, breaking down into the gap a little bit further into the end of the week, but finding some support off of one of our very faint lines here at 170.25 roughly. I would continue to just monitor for bearish outcomes, noting that we still have a ton of gap to close underneath us. There's still a strong opportunity for a daily lower high anywhere underneath 180.20. If this is going to flip to bullish, it's got to be a higher low above that level back inside of the earnings gap up range. Next up is NVIDIA. Notice that we are putting in bull flag consolidation here. We've got a little bit of a double top, so if you're a bear looking to play this in the downward direction, wait until the double top turns into a double top, aka a breakdown and violation of 210, offering up the lower low. If that happens, then fine, you can trade it down into 200. If this daily hammer candle results in upside, the first higher low above 217.50 intraday, you can look to trade back up towards the equal highs here at 229. If a daily break happens, there's quite a range above us to trade into 250.50. Gap closes at 258.25. Not calling for that in the coming weeks worth of trade, just pointing out there's some overhead room to run. Be mindful of earnings, still yet to report here in NVIDIA. Next up is going to be Microsoft. Really a confusing chart if you ask me. Things were looking good with the hold of the original gap, the look into it and fail from the Wednesday session, but things fell apart, of course, on Thursday, gap down on Friday, finding a hammer candle here. I think we need to wait for more clarity in this one. There's a short trade underneath 255.25 to make this rotation through the thin structure and retest the breakout point at 250 roughly, or to the upside, I really wouldn't want to get involved until we can break these highs at 275 for a more comfortable risk on type long. Sure, don't get me wrong, intraday scalps back and forth up here if we're making that ascent, but the better structural trade is over 275 at this point in time in Microsoft. Last but not least, the mini beast is Amazon. Hammer candle respecting this prior structural support once again at 96. Bullish outcomes only if this turns into a double bottom over 101.50 to start to trade into 108. If we remain underneath 101.50, you can clearly start to see the outcome as a head and shoulders pattern breaking down under this rough neckline. So underneath 96 even, just target this equal low here around 92.25 and monitor for continuation through the thin structure in this area all the way back down towards 87. I'd be a little bit skeptical of Amazon. Much better setups in something like NVIDIA bull flag, Tesla bull flag, or even even Apple bull flag. That's all for today's episode of the Weekly Watchlist. The audio quality should be much better for today's episode, although I know it is coming out late. We're going to do a pre-market live stream tomorrow morning, even though the market will be closed, just to sort of catch everybody up on what's been going on in my world. If you're interested in tuning in, go to Twitter and follow us on Twitter. This is not going to be a publicly posted video because we don't want to impact what's going on with this one. It's YouTube algorithm stuff, it's nonsense, it's creator stuff. So if you want to catch the pre-market live stream tomorrow, go on Twitter and look out for the link there, or join the Discord. It's down below in the description. It's completely free to join, and we'll post the link in the Discord. With that said, everybody, I wish you all a green trading week.